All right, guys, welcome back to the channel. This is a brand new series. We're calling it Investor Highs and Lows, and I'm really excited about this one. I think it's just gonna be a little more intimate. We wanna bring guests onto the channel, of course, and continue to fill you guys in with knowledge that we don't specialize in. And those guest experts are critical to the value of this channel. And I'm gonna start asking each one of them to share their highs and lows as well, because so much can be learned from other people's gains and failures. Anybody's mistakes can end up being a shortcut for you. And so we're gonna kind of dive in. I felt like it made the best sense for me to just kind of kick this thing off by sharing, my highs and lows when it came to investing. So let's start with the lows so that we can end on the highs. My biggest low in real estate investing came back in 2005 as we were just getting ready to hit the Great Recession that we all remember very well. And I was getting deeper and deeper into real estate investing. I've always been an advocate of house hacking, and house hacking is a term often used when you're not married, you don't have children. You can easily live in the homes you're buying and get great interest rates. You get reduced down payments and a number of other benefits that can come with it, but there are also some downsides to it too. But I was getting ready to house hack into my first multi-unit. And I found this, what appeared to be an amazing fourplex. Really good condition, 1,200 square foot units, side by side, townhome style with backyards. And it was an up down 2-bedroom, 2-bath per unit. And it just seemed good, but I was in this phase of my investing where the market was so red hot, like it is now, that many of us young and more inexperienced investors felt like you couldn't lose, and a lot of the reason we were buying was for speculated appreciation. We just kind of thought it was going to just keep going up. And unfortunately, I paid $315,000 for this fourplex, and I deliberately did not bring it to my mentors and coaches. And I've been getting coached and mentored now in business and financially since very early 2000s. I paid a lot of money for a coach. Reluctantly, I was terrified to do it. And my business partners at the time were very encouraging over the idea of coaching. And I managed to kind of step outside of my do-it-myselfer type of comfort zone and hired coaches. And I'd been growing my coaching team for a while, for a number of years by this point, and I just chose not to ask for their input. Why? Because I was so emotionally motivated by this specific property, and nobody was going to tell me not to do it. And unfortunately, closing in November of 2005 at a $315,000 purchase price, I had it appraised just 6 months later by May of 2006, and the property had dropped $180,000 in value. Interestingly enough, now we knew that the value had dropped that much because 2 identical model matches next door sold for $135,000. And if you know anything about appraisals, you'll know that they base it off of a few key factors, like recency of the sale. So something that sold yesterday is obviously going to be far more relevant than something that sold a year ago. Similarities behind the properties. So a model match, a property that's identical to the property you own, is by far the most comparable comp. And something in nearby proximity is a third factor that's being considered in appraisals. And these were next door. So obviously there was no disputing that the property value had fallen. And it was my first major lesson in the power of cash flow. Now, I always supported cash flow, but if I'm buying for speculated appreciation versus buying for cash flow reasons, it wasn't what was guiding my decisions. So this property, unfortunately, was only cash flowing about $150 per month for all 4 units total. It's not going to get you very far, guys. So this was a major turning point in my career, and I held on to this property for 4 years. And it finally became obvious that I was, in possession of a lemon. And sometimes you just have to decide when it makes sense to cut your losses. So what did I do at this point? Well, I learned from my mistake and decided that it was a good time to actually consult with my mentors and coaches about my best next decision. And we ultimately ended up choosing to short sale that property. So this was back in 2009 going on 2010. It did wash the slate clean. There were some legislative benefits to this where we were not 1099'd on the difference of the loss. So it was not counting as income against us. So in that sense, it was great. But here's the problem. By short selling a property, it destroys your credit. Most banks are unwilling to negotiate for less than what you owe unless you begin missing payments, at which point they will then negotiate and allow you to sell the property to another buyer for the actual value of the home versus what you owe. And so we got out from underneath it, but at the expense of my personal credit. So as a credit expert at that time, I was enthusiastic that I could get my credit turned around relatively quickly. And we did. I mean, it took about 2 years, but it sidelined me during two of the best buying years that have happened in my lifetime. And that was the lesson I took away, that had I just made the right decision up front to bring the decision to people that were way more qualified than me, to give me some insight as to the best decision I could have been making in that time, the chances are I probably wouldn't have ever purchased that fourplex, and it would have changed the outlook of my investing potential, in that downturn where all these properties were on sale, and so that was a really great life lesson for me, was bring it to your coaches. My best investing decision ever quite possibly just happened a couple days ago. I'm actually sitting here recovering from a minor surgery where I decided to make the decision to not have children permanent, if you know what I'm saying. With my copay on my insurance, it ended up costing me about $500. Comparing that to the roughly $250,000 it takes to raise a child these days, perhaps it was a great investment. We'll see. But if we're talking about something maybe a little bit more traditional than a vasectomy, maybe my best decision really came on one of my very first rental properties. This property is just outside Denver, and it's just a good old-fashioned, unsexy buy and hold. And I just cash flow the tar out of this house every single month. And it's been religiously paid on time every single month for 15 years. The long-term benefit of having that income stream is undeniable, and it is slow and it is boring. But the house is now worth hundreds of thousands of dollars more than it was. We owe very little on it. It'll be paid off in full within the next 18 months. And by that time, it'll be a free and clear asset that will pay us arguably until we die. Now, that's a tough decision. Real estate is one of those things where I never feel at total peace owning it. It always has this kind of lingering worry in my mind because I never really know what's going to happen. I've had basements flood. I've had bad tenants in the past. There are just too many unforeseeable circumstances that can take place. So for me, I don't love real estate exclusively, but it is part of my diversified portfolio. If I really had to advise on my best investment decision, it's been in myself. The times where I've spent money to advance my knowledge, the times I've spent money to expand my team and delegate, the times I've spent money on growing businesses, those have paid off 10x, 100x, and the types of returns that you can get are second to none when you're entrepreneurial. And not everybody has what it takes to be a great entrepreneur, but it's my experience that with courage, consistency, and patience, almost anybody is capable. You just have to figure out where you can get maximum trajectory, as they say, where you're swimming downstream. So many people fight the things they're best at only to scratch and claw up the hard road to reach any level of success. But if you really just triple or quadruple down on what you're best at, there are so many countless ways of monetizing those skills today compared to 10 years ago or 20 years ago that it really means anything is possible. So I would invite you guys to really believe in yourselves, really plug into some of those motivators like Gary Vaynerchuk, who would tell you very similar things, people like Anthony Robbins. Tune into people like Grant Cardone and watch some of these other really cool channels like Project Life Mastery. I love that channel. Or Alex Becker's channel, probably not the most politically correct educator, but man, that guy shows you how anyone can make extraordinary money. So I would encourage all of you watching this to figure out where you have the most entrepreneurial potential and triple and quadruple down on that. Guys, thanks again for checking out our channel. Make sure you subscribe and come back for all of the investor highs and lows that we add moving forward. Check out the other videos in the meantime. We'll see you on the next one. Until then, make it a great day today and take care.